So welcome everyone, and welcome Dean. Thanks, Dean, for I know you're an early riser, so
Yeah,
7:30 start for you isn't out of the ordinary, but I'm glad to see you've got a cup of tea there.
yeah,
So today we're going to talk about um, the other North American equity market, and Canada. I don't think it's quite fair to say Canada is overlooked, but clearly it lives in the shadow of the largest economy, and but it has some pretty interesting statistics about its own GDP that Dean can talk about, and in many ways it shares an equity income culture with the UK market that means it's a pretty attractive alternative source of equity income for those investors that have are mining the UK market for dividends. And Dean's managed Middlefield Canadian Income since 2011 when it first IPO'd, and he's been working on similar strategies for a lot longer than that. But I think it's quite interesting in the last year to use a 1980s TV cliche that the plan is coming together on some theses that Dean's held for a while, and you can see in the share price movement and the NAV movement recently that performance has been quite strong. And I'm not going to steal Dean's thunder by going into the reasons for that, but the timing of this meeting is really quite interesting because a number of strands are coming together. And so before I hand over to Dean, just very briefly, for those who haven't attended one of these before, you'll see in the bottom right hand corner there's a place where you can ask questions. If you type those in, we'll see those during the presentation. And if you have any technical issues, you can also put those in there and somebody will try to help you. So Dean will speak for about 15 or 20 minutes, and then there'll be a chance for he and I to talk over some of those questions. We're also recording this, so you can watch it back, and the slides will be available to download as well. And so with that, Dean, I'll hand over to you.
good stuff. Thanks, Alan. It's a pleasure to be with you today. And you're right that, Canada is at times overlooked when people think about investing in North America. And when you look at, what's happened really over the last 7 or 8 years, this market has been almost exclusively dominated by growth and growth stocks. And Canada really isn't, not unlike the UK, isn't really a growth market. So similar to the UK, it's more of an income focused market. And when we IPO'd this fund in 2006, it was our intention to bring to UK investors this opportunity to diversify into a uniquely um, income and growth market as distinct from growth and income market. And we think Canada really does provide some unique attributes that we believe really provides a diversification benefit to UK investors. Now, yes, we provide income just the way UK stocks do. In many respects, they're quite similar. However, when you think about Canada and really some of our advantages, it really is in the fact that we've got a growing population, and that's creating demand for all types of goods and services. And maybe more importantly, we've got an abundance of natural resources, in particular natural gas and oil, that for many years were dismissed. Again, when we launched this fund in 2006, there was a 5 to 10 year run in energy and demand from China. And Canada has an abundant source of safe, secure oil and natural gas reserves. And then, over that period from say 2016 to say 2022, 2023, the market was all about renewables, and people thought fossil fuels were kind of yesterday's news. And that's changed as well over the past couple of years. So I think we're now finally getting those tailwinds and that opportunity to not only get income from MCT, but to also get some growth over time. And as you mentioned, Alan, we've started to see that in the past 4 or 5 months, and we think the runway here continues to be quite significant. So let me just advance some slides here. This is just a bit of a background on Middlefield. Our firm's been around for now almost 45 years. I've been here for almost 30 years. And as Alan mentioned, we manage a number of diversified income funds, as well as some more specialized funds, whether they be in just energy or in real estate or in healthcare, but all of which offer a significant income component because that's part of our DNA is equity income. And then we've been in the UK in one form or another since the early 1990s, representing investors and providing unique Canadian investments for UK investors. And then it really culminated in launching this fund in 2006, which is listed on the London Stock Exchange. I manage this fund today with my colleague and our Chief Investment Officer, Rob Lazon. Rob's been with Middlefield for over 20 years now, so he and I have worked together for a long time. And we have a focus in this strategy on 3 key areas currently. While we can go up to 40% US investments, so it's always going to have a significant Canadian presence. Today we're 100% Canada, so it just shows you how keen we are on the Canadian market and the opportunities it's providing, and we'll get into some of that over the next few slides. But today it's really on financials, and we've got one of the best banking systems in the world, energy and energy infrastructure. What I mean by energy infrastructure is pipelines and natural gas gathering systems, as well as real estate. Our REIT market's a very well-developed market, which not unlike the UK REIT market has really been suffering from higher rates. And now that rates are starting to come down, you're starting to see a real turnaround there. Again, focus on quality. We've got about 35 names in this portfolio, what I describe as a high conviction strategy, not high concentration, but high conviction. Generally speaking, no name is over 5% of the portfolio or less than 1%. So we try to keep it in that 3 to 4% range on average, just showing you how much conviction we have in some of these names, and focus on quality. And one of the best signs of quality is size, and the average market cap in this portfolio is over $40 billion. So, we're focused on some of Canada's best businesses, many of whom pay a high and growing level of income in the form of a dividend. Our portfolio today, we think, is trading very attractively. And then when you look at MCT's shares on the London Stock Exchange, they're also trading at a discount. So I think there's a real good opportunity to get into this fund today because you're benefiting from this double discount, which I think will narrow over time. Again, high conviction, low turnover. And then our focus here is to pay this growing level of income to investors over time. We're running a covered dividend in 2024. We have over the past several years. That's resulted in a dividend bump in January of the last 2 years. And given the fact that we're running a covered dividend in 2024, the board will consider again late this year, early next, whether it makes sense to bump the dividend. But that's clearly how we're positioning the fund. So why are we excited about this strategy today? I mentioned a few of these points in the last couple of minutes. Number one, and these are 4 major catalysts, which I think investors really need to appreciate. Number one, the fundamentals across our portfolio, and I don't say this lightly, are as good as we've seen them in well over a decade. Canadian companies have done a good job improving their balance sheet, reducing their payout ratios, and fundamentally, we think they're in excellent shape. Number two, the valuations are as good as we've seen them over the past 10 to 20 years. And I'll get into that in a few seconds. And again, that's supported by the fact that our shares are actually trading at a discount. So again, you're getting this double discount that I mentioned earlier. And from a macro perspective, you're now starting to see some things that are clearly becoming more of a tailwind, which up until very recently were a headwind. First and foremost is cuts in interest rates. Canada's already had 3 cuts. We're estimating that you'll probably get at least another 4 to 6 cuts over the next 12 to 15 months. And again, that's bringing investors back into focus on equity income. They've been hiding in cash and cash alternatives in the past couple of years that have been paying them 5 and 6% yields. They're no longer getting those yields. Those yields are going lower. More and more of that capital is coming back into equity income securities like we own in this portfolio. And then from a geopolitical standpoint, I think there's some other factors that are creating a significant tailwind for MCT. Unfortunately, we've got some wars in Eastern Europe and Ukraine in particular, as well as the Middle East. And we think these wars, and in particular, when Russia went into Ukraine, we think it caused the world to reconsider its focus on renewables, in Europe in particular, because it was relying on renewables and natural gas from Russia. Canada's got one of the largest natural gas reserves in the world. As I say, we do this in a very responsible, environmentally friendly way. We extract that natural gas and we ship it. And now with LNG Canada being completed over the next few months, we're going to be shipping our natural gas over to Asia. So over time, I think people are going to come to appreciate more and more that you need oil and natural gas to manage this transition over the next 30 or 40 years to a more cleaner source of fuel. And Canada's going to play an important part of that. And I think that's now back on people's radar where, up until 2022, people were thinking that the world was going to be just renewables and that was going to happen over a couple of years. And we don't believe that's the case. And then last but not least is, as far as elections go, whatever happens in the U.S. election, we think it doesn't have a major impact on us. But what happens in the upcoming Canadian federal election, and we think we could have an election here over the next few months, the latest it will be in October of 2025, but we think that will also create some positive sentiment, assuming the Conservatives who are leading in the polls end up with a majority government. So just a couple of points here to support what I mentioned on the last slide. Number one, our focus is on income. We've been bumping our dividend. We're hoping to continue to do that over time, subject to the board's approval. And we believe we can do that because we're focused on companies in this fund that grow their dividend over time. And as you can see on the chart, MCT's dividend growth over the last 5 years has been over 8%. And over 85% of our portfolio companies have actually grown their dividend over the last 5 years. So those are some very powerful cash flow metrics that I think allow investors to continue to benefit from the success of these businesses. And on the right-hand side of this screen, you can see that our stocks today, as evidenced by the Toronto Stock Exchange, the TSX, are trading at about 15 times next 12 months earnings. The US market, by contrast, is trading at 22 times, and we know that's been elevated by the Mag 7 or the large cap mega tech stocks there. So even if you exclude the Mag 7 from the S&P 500, it's still trading at about 19 times next 12 months earnings. In other words, Canada, on a much more apples to apples basis, is still trading at about a 4-turn discount to the US market. And as you can see on this chart, you go back 10, 20 years, that wasn't the case. So we think there's a real opportunity here for a narrowing of that discount over time. And we think in light of some of these macro factors that are at play and the focus on dividends once again and capital coming back into equities looking for dividends, we think you're going to start seeing a real narrowing of that discount over time. This chart really shows, what happens to equities, and in particular the TSX, after the Bank of Canada starts cutting rates. And again, we started cutting in June of this year. We've had 3 cuts thus far. And as you can see, while the market historically appreciates after a rate cut, we still think we've got some runway here over time because we think more rate cuts are in store. And again, that's not only because Canadian investors are going to be putting money back into equities. We think even foreign investors are going to be looking to Canadian stocks, especially given the valuation differential that you're getting and benefit you're getting from Canadian equities. Some of that is really shown on this chart. We've looked at the amount of cash that's sitting on the sidelines, and it's really been built up over the last few years because beginning with the interest rate hikes, which started in the spring of 2022, investors really all over the developed world, and certainly in Canada, have never seen in the last 30 years a 5 or 6% yield on their cash deposits. In Canada, they are guaranteed investment certificates. In the US, we have certificates of deposits or money market funds. And again, with rates starting to come down, we estimate that there's somewhere between $200 and $300 billion in the Canadian market that's going to come into the fairway of the stocks that we own in this portfolio. So we think they're going to be benefiting. And thus far, very little of it's come in because a lot of that cash has been tied up in 90 or 180-day instruments, which will be coming due. And as it comes due, and the prospect of a lower rate on a GIC in Canada, we think that money starts to come back into equities. And that's just started to trickle in thus far. And as you can see at the chart at the bottom, the US market, by virtue of being how large it is, there's some $6 trillion that's sitting in money market funds, a lot of which will go into equities globally, including Canada. I talked a little bit about the federal election. We've had 9 years of Prime Minister Trudeau and the Liberals. For the last 4 years, almost 4 years, they've been under a minority situation. They had a support and confidence agreement with the NDP, the left-leaning NDP party in Canada. That agreement, just in the past month, has been torn up, which basically means we could get a non-confidence motion in Parliament at any point here that would trigger an election. And when you look at current polling data, the Conservatives are certainly leading in the polls. The leader of the Conservative Party is Pierre Poilievre. And based on some of his comments over time here, he is certainly much more business friendly, very different from Trudeau, who's more of a tax and spend politician. Trudeau clearly has not been promoting our vast energy resources, whereas Poilievre has been very clear that he's going to try to play to Canada's strengths, including trying to make a greater global market for our oil and natural gas in particular, which we think would be a real benefit to the Canadian economy and to the companies that we own in this portfolio. There's a very interesting chart here on page 9, which I think helps to investors understand the exposure we have in this and the importance of oil and natural gas. Each one of these companies in the rectangle are owned by our portfolio, and there's this spectrum of supply chain here. Number one is Tourmaline, one of our leading natural gas companies. Again, extracting natural gas out of the ground, basically using pipeline systems by companies like Enbridge, which again is one of our largest holdings in this fund, to ship that natural gas to a player like Capital Power, one of our larger utilities, who's actually converting the natural gas into power, and then basically selling it to companies like Brookfield, again, another one of our core holdings in this portfolio that's using it to fire data centers. We know that data centers are going to be a major demand and drain on electrical power generation. We know that that's going to put more and more emphasis on abundant sources of power like natural gas, and we've got that type of exposure not only from the extractors of natural gas like Tourmaline and Canadian Natural Resources, but also right through the supply chain for those people who actually distribute the gas like Enbridge, who convert it into power like Capital Power, and then companies that own the data centers like Brookfield, which will again power the AI and the storage needed by the Microsofts and the OpenAIs of the world. So again, even though this is not a tech fund, you can see the type of exposure we have and all the picks and shovels necessary to continue to drive this explosion in data and the need for data storage. Here you've got the performance going right back to inception. And as you can see, long term, we've done quite well relative to our benchmark. And then short term, as Alan alluded earlier, the performance has actually been quite strong because we're now finally starting to get the re-rating in these companies as a result of interest rate cuts. In that 3 to 7 year period, you can see the results have been more challenged because that really lined up with this period when investors were really not interested in equity income. They were really focused on growth. And as I've been saying, I think we've now entered a period of more market broadening. Rates will continue to move down, maybe not as fast as people thought, but we know the direction of travel is lower, and we think that continues to make what we own on this portfolio very attractive to investors. And that's clearly been evidenced by some of the returns we've generated on a year-to-date basis. So this gives you a sense for how the portfolio is positioned. As you can see very clearly, about 80% of the fund is really in three key sectors that we're very excited about: energy producers and infrastructure, financials, and then real estate. Our largest overweight position is real estate, and that has been one of the major contributors to performance, because you're seeing a real re-rating in real estate right now, because this major concern over commercial real estate falling out of bed and lots of bankruptcies hasn't materialized, and these companies have continued to perform very well over the last 2 to 3 years as interest rates have gone up, primarily because they're good, solid businesses with good balance sheets. And now, because of limited supply, you're seeing continued increased rents. Just a couple of comments here on Canada, and I've alluded to some of this, but we think Canada really does provide a very viable solution to this energy trilemma, providing security of energy supply, in particular oil and natural gas, very affordable because we've been able to reduce our costs and extract this oil and natural gas on a very cost-effective basis, and we do it sustainably. Canada is one of the leading players globally on carbon capture and storage. So we've put billions of dollars in capital into ensuring that we can really reduce the carbon footprint associated with producing oil and natural gas. And as I say, we've done a tremendous job, and the technology is improving where we think that's going to get even better over time. So again, when you're looking for a source of base load power, we think there's really no better solution than what Canada does here. And with that backdrop, you can see why we're so excited, because when you look at all the various metrics we consider when analyzing these oil and gas businesses, you can see how attractively they're priced right now. Again, they've got very pristine balance sheets. One thing that's happened in the oil and gas business over the last 5 years, as investors were more focused on renewables, oil and gas companies have really got religion. They've significantly improved their balance sheets, so i.e. reduced their debt. So companies like Canadian Natural Resources, up until very recently, had very little net debt on its balance sheet, almost zero, and was targeting 100% return of its free cash flow to investors in the form of higher dividends and share buybacks. I usually have a slide on this, but in the interest of time, we didn't include it. But Canadian Natural Resources has a compound annual growth rate of dividend of 20% plus over the last 20 years. So this company's been growing its dividend by about 20% a year consistently over the last 20 years, because they manage their business so conservatively, and because they are prioritizing this return to investors of this cash flow that they're generating. So we think there's a really attractive backdrop here for these oil and gas businesses, especially when considering the macro backdrop and people's renewed interest in oil and natural gas. On the financial side, again, we have amongst the most stable financials businesses in Canada, particularly our banks, where you had major challenges in the banking sector in the US during the global financial crisis. You then had it in the UK and Europe during the pandemic. Right throughout that period, our Canadian banks never flinched. We did not cut our dividends in either one of those crises. In fact, no Canadian bank has cut a dividend since the Second World War. And our life cos are equally as well positioned. And as you can see on the chart here, they're trading at attractive valuations as well. We highlight one of our life cos here in Manulife. Again, just an extremely well-positioned business. Although it's domiciled in Canada, its operations really are global, including a significant presence in Asia. And you can see that's been a significant contributor to its earnings over time. So a really well-run business, and has generated great returns for us over the long term, and in particular in 2024. Just a couple of comments on REITs. As I alluded earlier, this is a sector where we're significantly overweight. So in other words, it's a very high conviction part of the portfolio. We're one of the leading REIT managers in the Canadian markets. Our REIT funds here are among the top performing real estate funds in Canada over the short and long term. And REITs at the trough, as you can see on the chart, we're trading at about a 20 to 30% discount to NAV. And as a result of these reductions in rates, you're now seeing that about a 10% discount to NAV. Our 8 or 10 REITs in this portfolio traditionally, i.e. pre-COVID, traded at about a 5 to 10% premium to NAV. So this is why we continue to be excited about these businesses, because not only you're getting growing levels of income, we still think there's a significant re-rating opportunity. Why? Number one, demand continues to be very strong. We've had very little new supply in the areas in where we're focused, in particular, multifamily apartment REITs, industrial REITs that house, logistics and warehousing, seniors housing, retirement homes. Again, very little new supply has come on in the last 7 or 8 years. And then the grocery anchored kind of necessity retail REITs, all of whom are very well positioned and benefiting from this dynamic of limited amounts of new supply and growing demand. So hence, right across the board here, you're seeing rents continue to go up. And what's also quite healthy is that you're now starting to see some M&A activity. So large institutional players like TPG, as well as Blackstone, have been active just in the last 8 or 9 months. And we think now that there's greater clarity on the direction of interest rates, we think that provides these larger companies an opportunity to be able to put together the capital structure for further M&A activity. So we think that's going to continue into 2025. And that's positive because that creates a recycling of capital in the system. And over time, we think you'll continue to see a re-rating because it's going to validate the values that we're seeing. And an important point to raise here on the real estate is that while NAVs have been coming down up until Q2 of this year because interest rates have been going higher, now that interest rates are coming down, you're going to now start seeing some upward pressure on NAVs going higher. So although today we see them at a 10% discount to NAV, that could be closer to a 12 to 13, 12 to 15% discount to NAV because we think those NAVs are actually going higher. So just to summarize, and happy to take any questions, what are the major catalysts here? Number one, the fundamentals in these North American businesses is nothing short of excellent. So we think they're well positioned in terms of how they've structured their businesses and the outlook for them. Number two, the valuations. As we said earlier, TSX today trades at about 15 times next 12 months earnings. Even on a next tech basis, that's about a 4-turn discount to the S&P 500. Interest rates, direction of travel is clearly lower. So the Bank of Canada meets again the week of October 20th, if I'm not mistaken. We think we're going to get another quarter point cut at that point. And the FOMC doesn't meet until November, and the markets are telling us that they're going to cut a quarter point there as well. So that's clearly going in the right direction. And then last but not least, from a sentiment standpoint, in terms of the sentiment on oil and gas being better, as well as from a political standpoint in Canada being a more business-friendly government with the Conservatives coming to power, very likely here over the next several months, we think that's also going to create greater appetite for Canadian equities by foreign investors. So with that, Alan, I'm happy to take any questions.
Thanks, Dean. There's a question which I think we can perhaps we can apply both to MCT and to Canada as well as as we said at the beginning, sometimes Canada is a little overlooked, so maybe some of our viewers aren't so familiar with the drivers, but this is around where underlying income comes from, and I think there's 2 parts to that question. Who are Canada's big trading partners? I think we probably know the answer, some of the answer already. And who are the portfolio's big trading partners? So where does so for example, there's a kind of argument that the FTSE 100 is a very global index in terms of dividends because of the nature of the revenues, and I wonder if you could expand a little bit on the same idea for Canada.
Sure. So you're right. There's no surprise that Canada's biggest trading partner is the US. So about 80% of our exports go into the US market. And we're actually the US's largest export market at about 16 to 18% of their exports. And then when you drill down into our portfolio, so if you just take the energy and infrastructure, which when you take the producers and the pipelines together, that's our largest exposure in the fund at about 35% of the portfolio. Again, the vast majority of that historically, up until this point, is actually being shipped into the US. And as I alluded earlier, Alan, we've just completed our first liquefied natural gas facility on the coast of British Columbia. So beginning in as early as Q1, it's completed, but shipping won't start until Q1, maybe early Q2 of 2025. You're going to start seeing our natural gas reserves, and we've got over a 200-year life of natural gas reserves here in Canada. That's going to start shipping to Asia, where we're going to be getting a higher price. So that's the case on the energy and infrastructure, primarily the US, but now it's starting to diversify beyond that. With respect to our real estate businesses, our real estate companies, we've got some like Choice REIT, which is just focused in Canada, which is basically the largest grocery anchored retail REIT in Canada. Some of our multifamily REITs are primarily just in Canada. But then our industrial REITs, like a Granite, which is one of my favorite names, it's got significant presence in the US as well as in Europe. Dream Industrial has got properties throughout Canada, the US, as well as Europe. So you've got some diversification there as well. And then in the financials, again, the third largest weighting in the portfolio, companies like RBC, Bank of Montreal, Bank of Nova Scotia, TD, they've all got a significant presence in the US market, and roughly about a third of their revenues come from the US. So when you think about our portfolio in light of all that, you're really getting kind of Canada and US exposure, call it 90% of the revenues in aggregate. And then you've got some exposure to Europe and Asia beyond that, call it about 10% roughly.
Yeah, and do you want to talk a little bit, you've mentioned it a couple of times, a little bit about the pipeline sector, because obviously that's unique to Canada, and it's not something any other trading partner with the US can offer the US just by nature of geography, is it? So
Yes.
you're tied together. It's quite an interesting sector of the
Yeah,
market.
it's, we've been investing in the pipelines in Canada for over 30 years now. And it's a very attractive market. So let me just take a step back. You've got the energy producers, which are generally speaking significantly exposed to movements in oil and natural gas prices, depending on which commodity you're producing. And many of them, like Canadian Natural Resources, are focused on both. And on the other end of the spectrum, you've got the pipelines. And why we find the pipelines so attractive is that number one, they're much more stable businesses. So once I've built a pipeline system, Alan, I'm basically selling the capacity in that system on a take or pay basis. So I'm selling that capacity to the energy producers, and I'm basically contracting it on the basis of you either use that pipeline capacity or not, regardless, you're paying for it. And that's a significant portion of their revenues. So when you look at how the producers behave versus how the pipelines behave, the pipelines are much more interest sensitive. So they've got less growth, but they've got much more downside protection. And not surprisingly, as interest rates have come down, you've seen companies like Enbridge do very well this year. You've seen companies like TC Energy and Pembina Pipelines and Keyera, my other core pipeline holdings in the fund, do very well because of being viewed as more of an interest proxy. And with interest rates coming down, those stocks have gone up. The other important thing about these pipelines is that there's lots of NIMBYism going on, and there's lots of environmental concerns going on. So it's difficult, very difficult to build new pipelines. And as a result, there really is no alternative for those companies who are producing more oil and gas. And I'll give you an example of this. About almost 10 years ago now, Kinder Morgan, a large US energy pipeline business, owned a pipeline in Canada and basically wanted to triple the size of it, called the Trans Mountain Pipeline. And because of opposition from various stakeholder groups, including government bodies as well as indigenous groups, it basically said it's almost impossible to do that. And what happened was the federal government actually took over the project and now got it built. And now the federal government's got it built. They're looking to actually sell it back into private interests. And that was the only way that pipeline was going to get built, because the government basically forced their way into it. But they knew it was necessary. Another example that might be more relevant to your audience is the Keystone Pipeline. This was a very topical issue during the Obama and the early Trump administration, because the Keystone Pipeline is owned by TC Energy, one of our holdings in this portfolio, and it basically took oil, not natural gas, but oil from northern Alberta into Henry Hub in Oklahoma, the major oil distribution center in the US. But the pipeline going from the Canadian US border down into Oklahoma hadn't been built yet. And Obama canceled it, Trump greenlit it, and then Biden canceled it again. So you can see how difficult it is for anybody to get their head around this. And the reality is, TC Energy's effectively walked away from it, saying this is too difficult. We've got other fish to fry, so they've moved on. But again, that premium valuation is really ascribed to, number one, the fact that it's difficult to build more of them. So there's more value in those companies who have pipe in the ground already.
Yeah, thanks, Dean. I wanted to pick up on something you mentioned about REITs. There's a couple of questions about REITs, and again, for those less familiar with Canada, this might help to bring to life some of the dynamics of that market. But you mentioned limited supply as one of the drivers. That your REIT holdings aren't just about the discount, are they? There's more to it than that, and it might seem extraordinary to somebody who thinks of Canada as geographically one of the largest or the largest country
Mm.
in the world with a population of 40 million as having limited supply of
Mm.
real estate. So do you want to talk a bit about the market, and then perhaps talk, there's a specific question about how geared some of your REIT holdings are as well.
Sure.
Something.
Yeah, it's a great point because when you get in an airplane and you fly over Canada, which I do very regularly, and you look down and you say, "My goodness, what a vast country. Look at all this land." The problem with that is that virtually um, all of that land is uninhabited. All the municipal services are basically concentrated into 8 or 9 different major cities. And in fact, about 80% of Canada's population actually lives in an urban center. 55% lives in our 6 or 7 largest cities. So they would be Vancouver, Edmonton, Calgary, Toronto, Montreal, Ottawa, and Halifax. We've actually seen some growth in Eastern Canada and Halifax. And you're seeing actually growth in Eastern Canada, net migration into Eastern Canada and into Alberta because the cost of living there is actually a little bit lower. But the reality is that's really where the population centers are. So when we actually even get immigration, we've had lots of immigration over the last 5 years, and that's now starting to slow. And that's really created this significant mismatch between the supply of real estate, or sorry, the demand for real estate and the supply of real estate. The reality is you don't have enough um, housing, you don't have enough retail centers there to support this. And uh, what's exacerbating this on the supply side is that, number one, the cost of construction is very high. So I think you're dealing with the same things in the UK. We've got a shortage of skilled labor in this country. Number two, the municipal charges and levies that have been placed on by municipalities, as well as provincial and federal government levels, is high. And that can total as much as 30% of the cost of construction. So that's made it prohibitive. And then thirdly, we've actually had this rise in interest rates, over the last 2.5 years. So as a result, you have had very little new supply come on, and we need to find a solution for that. And fortunately, the federal and provincial governments are now trying to provide subsidies and tax incentives to drive the amount of new supply. We were a little worried that they start putting more rent controls on, and fortunately, they didn't do that. But they have been providing significant reductions in financing costs. So there's a program that we have here for residential development where you can actually borrow for a new purpose-built rental at about 150 basis points lower than the prevailing rate that you would get from a bank. So those are actually really good programs. They're talking about other types of tax incentives and waiving certain taxes on new development. Those are the types of things we need to happen in order to drive new construction. The reality is it's not going to happen overnight. So when I look at my real estate holdings, and again, there's 4 sectors that we're exposed to. you got grocery anchored retail, you've got the apartment multifamily REITs, you've got industrial, so the warehouses, the boxes, and then you've got seniors housing. Each one of those areas is seeing growth in revenue, so growth in NOI, so their costs have been managed down, especially since the pandemic where costs went up. Occupancy is going higher, rents are going higher, and we're talking on the order of about 10 to 12% increases in rents, converting into 3 to 5% increases in cash flow. So when I'm looking at that type of backdrop on these REITs, this is really encouraging because not only are you seeing some very positive fundamentals there, you're seeing interest rates starting to come down, and investors, as I've been talking throughout the slide deck, now saying, I need income, and these REITs are yielding 5 and 6%, and that's going to grow over time, plus they're trading at a 10 to 12% discount to NAV. It's a really attractive, powerful combination of scenarios, assuming our house view that rates will continue to nudge lower over the next 12 to 15 months. And we avoid a recession, which looks like we have, for sure.
Yeah, and I wanted to pick up on one other thing you said, which is, so a UK equity income investor is a pretty extraordinary statistic that Canadian banks haven't cut their dividends since the Second World War. What is it about Canadian banks? What's the culture that leads them to be so stable?
So one, not unlike other aspects of the Canadian economy, it's highly regulated. So there's two things I would mention. When you look at our capital ratios, Alan, they're actually amongst the highest in the world. So that's been a significant buffer to economic slowdowns and economic volatility. And that allows these companies to continue to grow their dividend over time. So not only haven't been cut, there are very few years where they've actually not been increased. We had a period during the pandemic where they skipped a year, and then they really more than made up for that in 2021 and 2022. So there's that. Number two, when you actually look at the return on equity for the Canadian banking sector versus, say, the European banking sector, you look at it historically, our return on equity is anywhere between 13 and 16% per annum. That compares to anywhere between 4 and 7% for your average UK European bank. So the stability is certainly there. And part of that is because of our regulatory environment, that our regulator, the Office of Superintendent of Financial Institutions, basically has been ensuring that Canadian banks have a higher level of capital, which basically means you might sacrifice earnings growth over time. But the flip side is that you actually create more downside protection in the event that you get into a slowing economy.
Yeah, thanks. And then I just wanted to briefly touch on your gearing and what we might be able to read from that in terms of your optimism. I think you've already painted a fairly optimistic picture, and then just talk about, you've had some quite big share price moves in your portfolio. So how have you been adjusting the portfolio over this year?
Sure. So, firstly, in respect of gearing, we have the ability to borrow up to 25% of total assets. So, over on the grand scheme, I think it's fairly modest, but it's a valuable tool for us because we're able to manage it very strategically, and if in fact we think the market is maybe gotten ahead of itself, is overvalued, you would see us run that gearing down to 5 to 10% of total assets. When we feel really constructive about markets and we think they represent good value, like we're seeing today with lots of tailwinds, that gearing is going to be somewhere between 15 and 20%. And that's where we are today, Alan. We're probably in that 16, 17% range. And again, to your point, that was closer to 17 or 18%. But by virtue of growth in the underlying portfolio, the amount of gearing as a percent of total assets has come down. So that's providing us with a bit of wiggle room if we wanted to take some capital and put it to work in some attractive securities, and we're considering that right now. So this band of 15 to 20% is, generally speaking, the upper end of the range for us. where we feel like there's good value in lots of our core holdings. We're looking at some new potential additions to the portfolio, but on balance, we think that's telling the market that we think there's good value in the areas where we're investing.
Okay, I think that's covered most of the questions on the Q&A. I would, of course, point viewers to the Trust's own website, where it's amazing how much effort goes into producing fact sheets, reports and accounts and other documents. And I always encourage people to read those alongside everything else that they do. And of course, Kepler has its own website with a wealth of information as well, which I would refer you to. I'll conclude by noting that it's a matter of public record that Dean and the manager recently increased their holdings in the trust as a further measure of their optimism. And I know many investors like to see skin in the game as one of the factors that helps them to invest in something. So yeah, you can go and look at the London Stock Exchange announcements and see that for yourself if you want. So Dean, thanks so much. It's still early for you, so
Yeah,
hopefully you'll get a break before you.
yeah. The sun's coming up here, Alan. You might have noticed that I had this glare on my face, so I had
Yeah,
to draw my blind a little bit. Yeah, so we're just after 8 o'clock here,
yeah. So I
but
really appreciate you getting up so early to
oh,
do
my
this.
pleasure.
And to everyone else, thanks for attending, and we will see you on the next one.
Wonderful. Thank you.